Which one is better, GPiQ or JEPQ? Let's compare. Two ETFs, both paying around 10% yield, both built around the same NASDAQ 100 stocks. So why are investors debating GPiQ versus JEPQ like it's a heavyweight match? Let's break it down. JEPQ is the veteran here. JP Morgan launched it back in May 2022, and it's grown into a $33 billion giant, one of the most popular covered call ETFs on the market. GPiQ is the newer challenger from Goldman Sachs, launched in October 2023 with about $3 billion in assets. Smaller, younger, but making serious noise. Both funds hold the same core names: NVIDIA, Apple, Microsoft, Amazon, Tesla, and both use a covered call strategy to generate monthly income. That's where the similarities start to end. The biggest difference is how they write those covered calls. JEPQ uses equity-linked notes, essentially structured products, to generate its income. GPiQ uses a more flexible, dynamic approach, adjusting its call coverage anywhere from 25 to 75% of its holdings, depending on market conditions. That flexibility is a big deal. It means Goldman Sachs can dial up the income generation during volatile markets and pull back to capture more upside when the market is running hot. Now let's talk numbers. JEPQ currently yields around 10.7% and has a 0.35% expense ratio. GPiQ yields around 10.3% and charges just 0.29%. That yield gap is actually pretty small when you factor in that GPiQ has been delivering stronger total returns. Since GPiQ's inception, it has outperformed JEPQ on total return, and historically, total return is what actually builds your wealth. JEPQ does have one edge. It's been around longer, it's more battle-tested, and some analysts consider it slightly more resilient during NASDAQ drawdowns. Both funds have had maximum drawdowns of around 20 to 21%, so neither one is a safety net when the market drops. For tax-conscious investors, GPiQ also has an advantage. A portion of its distributions can qualify for more favorable tax treatment compared to JEPQ's derivative-heavy structure. If you're holding this outside a retirement account, that matters. So who wins? Honestly, it depends on what you're optimizing for. If you want the bigger, more established fund with a slightly higher yield, JEPQ is a proven product. If you want lower fees, more flexibility, and stronger total return history, GPiQ is the one to watch. Personally, I think GPiQ is the more sophisticated tool, but either one can play a role in a well-built income portfolio. Just remember, these are not traditional dividend stocks. The income is generated from options premiums, not company earnings. That's a different kind of risk, and you need to understand it before you invest. Drop your questions in the comments below, and if you're holding either of these in your portfolio, I want to know, are you team GPiQ or team JEPQ? See you in the next one. See my profile to read more free details on Patreon.